Welcome, friends, to this webinar of SATCO AQF PMS. We have been making regular webinars and interacting with all of you. And today we are happy to be again once more interacting with you. I'm joined by Nitin, Jay, Varun, Neha, the entire SATCO PMS team. Friends, we are in a very interesting times. Post-pandemic, we have seen waterfall in month of March, April, and then water rise. Nobody had expected this kind of improvement in the world markets, world over. Not only India, of course, but anywhere else in the world had not seen this kind of, we had not thought of this kind of improvement in world markets. So this is something of a enigma for all of us, and a very interesting time when the world markets are at their highs. But it is said that rising tide lifts all boats. It's when the tide settles down, you know which of the boats are strong and are able to weather the storms. SATCO PMS, growth and momentum, has weathered all the storms. We have over last 9 years given phenomenal returns. From inception, when we started in 2012 till today, I think we have returned more than 29.9% CAGR, beating the CNX 500, which is our benchmark index, by well over 16.8%. So there has been reasons why we have been able to do that. And the reasons are that we cut out all the noise. We focus on fundamentally strong stocks, good balance sheets, good business models, good managements, and we have been disciplined in that regard. Absolutely focused on the kind of stocks that we can choose. And once we have chosen those stocks, we go with our conviction. So despite what we have seen, the carnage we saw in the month of March, April, we kept our cool, and it has paid us handsome dividends. And for our investors, of course, everybody is gained in the process. So now, that got us thinking that, of course, we have this growth and momentum scheme, which has seen phenomenal returns. Why don't we launch another scheme which focuses on the 200 stocks? And these are the blue chips. And that is why this scheme that we are launching is also called the Tru Blu. Of course, I'll leave it to Nitin, who will head the discussions today and who will be driving this fund, to also let you know what this Tru Blu is all about. And we are confident that, like growth and momentum, and Tru Blu will even return a much better returns than what growth and momentum have done. I request now Nitin to take over and give you a presentation of Tru Blu scheme that we are about to launch. Nitin, over to you.
Thank you, Naresh. Thank you for your kind words. Welcome to all our friends and investors. As you know, in SATCO, in our PMS, for the last 9 years, we've actually been running with just one product. And that has been based on a belief that we've always been growth-oriented investors. And we have not, we've never launched products just for the sake of raising AUMs. So in our view, our existing growth and momentum product was and continues to remain an evergreen product, which we continue to focus on. We continue to try and deliver returns and growth as such. However, as it happens from time to time, and as it happens when more so during challenging and difficult times, we stumbled upon our new product, which is the Tru Blu portfolio. As we were doing research in terms of how to manage these tough times, how to deliver consistent long-term returns, during the course of our internal research and studies, we came across some very interesting facets, some of which we have been discussing with you every month for the last 3 or 4 months running. And that's how the genesis of the Tru Blu portfolio emanated. Uh, so we thought, it's a great time to launch it, more so as markets continue to rally and markets continue to be high. There are a lot of questions and doubts in investors' minds in terms of the sustainability of this rise. Whether one should be investing now, whether one should be selling now. So I thought, the Tru Blu actually gave us uh, a theme or results which we back tested for over 10 years, which gave us immense confidence that it's an evergreen portfolio, just as our growth and momentum portfolio. Uh, Slightly different in terms of the universe that it targets, but uh, the same confidence that it would deliver numbers through good as well as bad times. So without much ado, I will, run you through a very short and a brief presentation on the Tru Blu portfolio and why we think it is a very exciting new product that we have bought into the markets and our own expectations from it. So, like our flyers that went out to you talked about it being a Tru Blu portfolio or a rules-based approach to blue chip investing. So, just before as I launch into it, just a very quick recap. As you know, the SATCO PMS is run in a very professional manner. We have an investment committee which oversees all our investments, which meets on a regular basis and reviews all our current and potential investments. There is a layer which stands over the investment manager, which acts as creates checks and balances. This committee is comprised, as you know, of myself, Mr. Naresh Tejwani, um, and Mr. Rajendra Babani, one of the promoters of SATCO. And we have Mr. Anmol Sekri, a very renowned individual investor, a valuation expert who runs among the top oldest and most well-known valuation companies, who sits on our board as such. Um, Quickly diving into the Tru Blu portfolio, our objective was to sort of balance our portfolio offering. The growth and momentum portfolio is a cap agnostic portfolio, but it has a tint or a orientation more towards mid and small cap companies. As such, we do have large cap holdings. Typically, you will see that we will have about 30-35% invested in large caps, but a majority of it is more towards the mid and blue, the small cap companies. Nothing really distinguishes themselves from a management quality, because even the kind of companies we invest out there have the same pedigree and quality of management. However, the blue chip or the Tru Blu portfolio is going to be focused on blue chip investing. So we went back to the drawing board and said, okay, what is the generally speaking, we have a lot of investors who approach us and say that we want to invest in blue chip companies. Now, blue chip is very loosely and defined as a terminology. And, we've seen over the past that the companies, generally investors refer to blue chip companies more from a perspective of well-known names, index companies, and so on and so forth. So we said, okay, how do you define blue chip? So as per Investopedia, which is an equivalent on the internet of, say, Wikipedia or so on and so forth, as a company, blue chip is defined as a company who is nationally recognized, well established, and a financially sound company. They generally sell high quality, widely accepted products and services, and most importantly, are known to weather downturns and operate profitably in the face of adverse economic conditions, which contribute to the long record of stable and reliable growth. Uh, uh, Ironically, the name blue chip also emanates from in poker from the highest value chip that is there. So the essential characteristics of blue chip companies are uh, their ability to offer products which are well known, and their ability to do well even in uh, challenging times and deliver numbers, and hence they are normally valued at premiums to the market. So what is this approach we decided to follow? We call it the rules based approach. And why do we call it a rules based approach? So what we did is that we found, if you remember, a few months ago we had made a presentation where we had talked about how we had gone into 12 years of history and identified market corrections which were of significance. And when we defined market corrections of significance, we talked about them being anywhere in excess of 24 to 25%. And we saw that these kind of corrections happened regularly in the markets at durations of 3.5, 4 years intervals. So, whether it was in 2008, whether it was in 2012, 16, 20. And in the intermittent, we also have number of numerous 5 to 10% sort of corrections which markets face. As it would have it, and I would like to believe that we've seen that 4 year cycle repeat itself in 2020 when we had a 38% correction in the month of March when lockdowns were introduced and COVID started, erupting all over the world. So we went back and said, okay, how does one withstand these sort of volatile periods and corrections? Are there companies who do well during such periods? And to our own surprise, out of the broader 500 universe, we found that there were almost 100 companies who performed very well during each of these downturns in terms of their returns to the investor. So and we said that when the markets did correct at such periods, during such periods and times, were there companies who would continue to deliver 15% CAGR returns in terms of their stock prices for investors? And we found that on an average, roughly around 80 to 100 companies stood out in each of these downturn periods. Uh, when we looked at the attributes of these companies, we found that each of these companies had very similar attributes. And that is the genesis, my friend, of how we started and approached the Tru Blu portfolio. So we said these were companies who showed strong growth. These were companies who had efficiency of returns built into them, which means that how they use capital and what kind of return they delivered on that capital was very, very important. These were also companies who, as you said, had well-known products. So because of which they had marketing strength and had ability to demand favorable terms in markets, which resulted in strong cash flows. So we used these, and they had far lower volatility as far as their earnings was concerned. And this is all a function of great management. And hence, we called it Tru Blu. True growth, return on capital, unparalleled cash flows, balance sheet strength, low volatility, and unmatched management quality. So what was the what so we said, if we found that when we were initially doing it over 500 companies, we said let's take it down to the top 200 companies or top 200 names that prevail in India. So we took the BSE 200 index and we decided to run this on companies within that index. We used proprietary indicators, which comprising of growth, balance sheet quality, and cash flows, and we ran back-tested numbers on them. So what did we do? We essentially said, if over the last 2 years, there are companies who have been able to deliver all these 3 or 4 attributes, and we created a portfolio out of these companies, what would have been the return of that portfolio of companies in the next year? So to explain it to you even more simply, we said that we took 2010-12 as the 2 years first and said, out of these 200 companies, how many companies would qualify based on these parameters? So when we found that during this period, we came down to 35 to 40 companies who had attributes of growth, return on capital, and cash flow. So we said, okay, if we were to create a portfolio of these 35, 40 companies, how would it have done? How would this portfolio of companies have performed in the next year, 12-13? Now, the underlying logic and rationale is that, normally speaking, when companies and businesses hit a purple patch in terms of their growth cycle, normally a growth cycle lasts for 3 to 4 years. So we said, let's take the previous 2 years and use that as a basis for creating a portfolio for the next 1 year. So we did that similar testing on numbers. So first we did 2010 to 12 as the historical numbers and created a portfolio for 12-13. Then we did 11 to 13 as the previous 2 years and created a portfolio for 13-14. And thereby we actually ran these tests for 9 years running. Right? So 12-13, 13-14, 14-15, 15-16, 16-17, 17-18, 18-19, and 19-20. So we ran and created portfolios based on their historical previous 2-year numbers for each of these 9 years to see how a portfolio which showed proven growth, return, and cash flow would have performed in the third year as such. In each of these periods, we found that out of 200 companies, we were coming down to 30-35 names. And so we said, okay, that's great. Can we further reduce it to the top 20 names? So we have created a portfolio of 20 names, maximum concentration in each name. In our back test, we took equal weightages, but we have allowed maximum concentration in a good company to even maybe 10%. What we found was that the average market capitalization of these companies was 40,000 crores in our numbers. So what was the result of this portfolio that we saw that we would create? Right from the day one, this portfolio outperformed the index. And let me just throw a little more light for you on this. This portfolio was created on the 1st of June every year. What we said is that 31st March is the year ending. All the companies declare their numbers and results between March to June. Almost 90-95% of companies declare the numbers in this 2-month period. So this portfolio was created on 1st of June. So the numbers that you see of returns are from 1st of June to 1st of June for this portfolio. So in the first year, the market did 0%, market as defined by the BSE 200 index. This portfolio delivered 40%. In the second year, the market did 25%, this portfolio did 38%. In the third year, 17%, 64%. In the fourth year, the market delivered -2%, this portfolio yet delivered +6%. And in the third year, the number was 21 and 30. In the fourth year, in the sixth year, 11, 16, seventh year, 9, 11. In the the eighth year, While the market was down 18%, the portfolio was down only 2%. So, and now in the current year, as of now, this portfolio has delivered a 31% return from 1st of June till now, vis-a-vis a market of 29. So, as you can see, consistency is the hallmark of this portfolio. Outperformance vis-a-vis the market is a hallmark of this portfolio that we have seen. Rupees 10 invested in this model at the beginning would be valued at 72 rupees now. Similarly, rupees 10 invested in the index would have doubled to 22 rupees. So there has been a not only there has been a huge outperformance on this portfolio, and as you can see, one of the attributes of this outperformance has been the ability of the portfolio to perform well in challenging times. And that means that it falls far less, it collects a huge outperformance, and it rises much more when it goes up. So basically, it starts collecting outperformance in this cycle, and hence you see this reason for this huge outperformance as such. We also ran it for the last 3 years. The last 3 years, as you know, has been a very challenging period in the market. Of course, people have short memories and hence are looking at what we have seen in the last 6 or 9 months and seeing a heady rise. But actually speaking, if you look at the market from where over the 3-year period, you will see that if you had invested 100 rupees in the market, this market would have only delivered you anywhere between 13 to 14, 10 rupees would have been valued at anywhere between 13 and a half or 14. So about 30% return in 3 years as such. But this portfolio was again outperforming, as you can see the blue line showing you, even in this time period. In the last 1 year, again, essentially the markets have been flattish to have delivered a marginal, maybe a 20% return. This portfolio has delivered a sizable outperformance, again, as the blue line indicates. So whether it is short periods of time, whether it's long periods of time, or extended periods of time, the portfolio has delivered consistent and outperformance. What we did further is we said that, typically these numbers were for a portfolio of 35 to 40 names. We said we want to choose only the top 20 names out of that. And what we saw is that the results of that top 20 names were even better as such, because that is what we are going to do in the proposed portfolio. This portfolio that we are developing is going to be comprising of 20 names, as I shared with you in an earlier slide. And so we believe that the returns will be optimized. And that's where, if I were to sort of step back a few slides and show you, what we are doing is creating 15-20 stocks in the portfolio of average 40,000 market cap. But after we have selected our universe of 35 names, these 20 stocks, we are going to use the same rigorous research that we have been using all these years to identify stocks in the growth and momentum portfolio, to identify the best 20 names. And that's how we expect to actually even beat the model that we have created as such. So as you can see, our own expectation is, in a worst case, we will deliver what the model shows us. In a best case, we will do better than that as such. To give you a flavor of the kind of names that come out and stand out in the portfolio, we have shared out here the top 5 names that delivered positive returns. We have also shared the names which delivered negative returns in the portfolio as such. So as you can see, among the names that stand out there, these are all names that you have all heard of at different points of time. So if I were to start from slightly below the last period in 1920, you have Divi's, you have HDFC Asset Management, you have Nestle, Indraprastha Gas, Whirlpool. Going up, you have Bata, Bajaj, ICICI, Lombard, Muthoot, UPL. Further up, Bajaj, Astral, Polytechnic. So as these are, as you can get, the objective of sharing this was to give you a flavor of the names that stand out here as such. We also ran a monthly portfolio performance to see how this portfolio would perform during big drawdowns or big challenging times in the market. So we took first the March 15 to September 16 period, which was the period when the markets corrected close to 20%. This portfolio was down 4.5% during the same period. The subsequent bounce back saw the 200 index bounce back almost 24%, while this portfolio bounced back 30%. So, again, it was very encouraging and sort of played out our hypothesis that this portfolio manages during downturns far more efficiently. Again, if you took the current downturn which happened between Jan 20 to November, if you remember, the portfolio actually markets actually went down sizably. The markets corrected, the index corrected from 1st Jan till now during March 31.5%, and then they sort of bounced back. So you can see this portfolio corrected 26%, which was almost as 5 to 6% less than the market. And when it bounced back more than the market. So once again, it showed the kind of resilience that we are happy to see as such. So all in all, if I were to tell you, if I were to sort of come back and share. Just a second. Stop sharing. Yeah. So all in all, if I were to come back, we believe that the blue chip portfolio sort of enables us to identify the best companies among the top and the most well-known names in the country. And one of the other reasons why we are so enthused by what we saw out here was the fact that, we have a lot of investors who normally approach us with their portfolios and say, you know what, I invested in this name, this is the blue chip name, but it hasn't done anything. We haven't got any return. So we didn't want to go by the traditional definition of blue chip. We wanted to define blue chip in a different form. And for us, a blue chip was a company which delivers growth, return on capital, and cash flow. So for example, I mean, today we all talk about Reliance, but if you jog back in your memory, you will find that there was almost a 5-6 year period where Reliance actually delivered no result or no return for shareholders, and now it suddenly delivered these kind of outsized returns. Similarly, we've seen, so every blue chip goes through such cycles where it has a virtuous uptrend, and we've also seen a lot of the blue chips, like even in Asian Paints and so on and so forth, they all deliver these returns in compressed periods of time. So there will be that 2 years or 3 years where you will see huge outperformance by these blue chips, and then they flatten out for a long period of time. Now, most investors like to invest in blue chips, but when they see that their portfolios are stagnant and markets are moving, they get sort of flustered and worried. Oh, what's happening? Now, so we said, look, this sort of portfolio, what it does, it identifies the blue chip in that virtuous 2-3 year cycle, like we said, when the blue chips are delivering their maximum returns. Because one of the attributes why the blue chips also deliver that return in that compressed period of time is that's the time when either of these 3-4 attributes start falling in place for that blue chips. And so while a blue chip might be delivering, let's say, if you look at Asian Paints or Hindustan Lever, they will have high return on capital for extended periods of time, but they will deliver the returns during a compressed period of time. Because what happens is that during the period of time, there is a very limited period when their growth rates get upped, and that's when the stock tries to catch up with the revised growth numbers and delivers the number. So we think that this approach that we are following, which we call it as a rules-based approach, helps us to shortlist the blue chips that we think will do well and create a portfolio of such blue chips to deliver returns, in the time period going ahead. So yes, so that's so we feel extremely confident. We've seen that over this 9-year period, this portfolio chosen using this methodology uh, in its backtest numbers has actually delivered close to 26-27% compounded returns. That, along with names which make you sleep well at night, I think creates, in our view, a strategy which is very promising. It's a strategy which is scalable, and we are very, very excited to present this to you, our potential investors. Thank you. Jay?
Yeah, thanks, Nitin. Let's start the Q&A round. I invite attendees to put in their questions via the Q&A box. Nitin, we already have some questions.
Yeah.
What is the weightage of financials in the Tru Blu portfolio, and what is the quality of financials that the model has thrown up over the last 10 years?
Okay. So that's a good question because, I think if you really understand that financials are valued a little differently, right? So what we did as far as financials is concerned, because you can't value financials based on cash flows, because cash flows, when you look at a standalone business, it makes sense to do that. But for financials, cash flows comes and it gets rotated and to grow the business. So for financials, we looked at return on equity as a key parameter, and we put a 17% hurdle rate. Mind you, 17% is very, very high. Most PSU banks don't even qualify anywhere close. They don't even reach double-digit return on equity. So, and even among the so-called private blue chip names, there will be very few which qualify. So that is one. The second is we looked at growth. And having done that, so we run our model for financials separately. What we also do is that um, uh, financials have typically a 30-35% weight in the index. So we have allocated a similar weightage into our portfolio. So typically we believe, and it could be slightly off here or there, but we do believe that at any given point of time, financials will have a 30% to 35% weightage. And that could mean that out of the 20 companies, it could be anywhere between 6 to 7 companies that could qualify out there.
Right, Nitin. Nitin, for mutual fund investors who have been traditionally with large caps or large to large mid caps, how do you think Tru Blu as a product is for them?
I think it's a fabulous product for them, if you ask me, because ultimately, when you invest, I presume that when you go and invest your money in a blue chip mutual fund scheme, you're going there because while you like risk, your threshold of risk tolerance is a little lower than a average bottom up mid cap or a small cap investor. So, but you're going there. Now, however, what happens is, as we have seen in various studies that we have done internally, uh, if you're going to go and invest in 60, 70 names, which a typical mutual fund does, and what we saw is that during different periods of time when we did our analysis, we found that there are only about 30 to 35 to 40 names which actually qualify based on uh, top rung growth, based on returns, and based on cash flows. So that means that the other 20, 30 names which are there are placeholders. So hence the returns get diluted when you have a portfolio of 60, 70 names, when we found that at every given point of period, there are only 35, 40 names. However, if you are in a mutual fund which has a compressed portfolio of 25, 30 names, it's likely you would get similar returns. But then the point is that what we have seen is that in our case, one other attribute is that we have worked this rules-based approach without any biases, and have created a portfolio based completely on that as such. So I do not know about the strategy that a mutual fund would take to do that, but in our view, this is our secret sauce.
Right. The next question, will this portfolio only focus on stocks which are already blue chips or also emerging blue chips? That is stocks that are not at the threshold of 40,000 crores but has the potential to be there.
So as I mentioned to you, our universe comprises out here the top 200 names. The top 200 names, as defined by SEBI, comprises from 0 to 1 to 100 is the large cap names. From 101 to 250 is supposed to be mid cap. So when we are going only up to 200, so it's essentially the larger mid caps. Now, the definition of a blue chip can vary from person to person. In my view, so we are going in for the larger mid caps and the large caps as our universe, and we are going on the basis of performance which has been delivered consistently over the last 2 years. Now, so essentially these are proven blue chips, if you were to call it, that we are going, and not for what we think is emerging. For that kind of emerging blue chips, for emerging companies, I think the growth and momentum is the place to be.
Right.
However, I might also add out here that we will have a lot of these so-called larger mid caps, which are transitioning into large caps as such. And I think that's a sweet spot to be, because if you have sort of heard about, if you know about the Bajaj Finances of the world, now what typically happens in this is when you are an emerging mid cap and you deliver this kind of consistent growth and you transition into a large cap, your re-rating happens in the markets as such, because that's the time when institutional investors also start jumping in and you see a re-rating of your valuation.
Right. We have a similar question to the one just answered. What are the similarities between GNM and Tru Blu? I mean, from the angle of if an investor is already invested in GNM, so how is this product different? How would you differentiate this product?
So the differentiating factor, as I mentioned to you, is two or three. One is the fact that the GNM portfolio typically will have anywhere between 50 to 60% in mid and small caps. We don't do it by design, but the strategy is to look for high growth companies out there. The growth bar that has been set is far higher in the GNM portfolio at companies who double every 4 years. So we're looking at 19.5%, 20% compounded returns out there. And so hence you get a lot more mid and small cap names coming in there. You do get a few large cap names also coming in. So, but typically we have found that on average, a large cap weightage is about 35% to 40%. That's one. Vis-a-vis here, which is the market capitalization of an average company in this portfolio is going to be far higher. Also, the growth number that we have chosen, because these are far larger companies, is a little lower than the growth and momentum portfolio. Number two, in the growth and momentum portfolio, we look for turnaround companies. We look for companies who are emerging. So we are looking for what we think is our ability to identify forward growth stories where businesses are transitioning on a small base and have a potential to go on a large base. In the Tru Blu portfolio, we are looking for verification of that. So you could very well have a scenario where in the growth and momentum portfolio, we have something which we identified in the mid-cap space. and which has done well over 2 years, and that qualifies into the Tru Blu space. So in Tru Blu, there is a further added, if you were to call, verification bias that comes in, that these companies have proven themselves, and and that's how they come into our radar.
Right. Nitin, for investors who already have large caps in their portfolio in direct equity and who also have mid caps, how would you position them between choosing GNM and True Blue to make their entire portfolio?
We think this is a GNM and True Blue will actually, when you help you to identify the best of the large caps and the best of the larger mid caps as such, and will constantly be uh, uh, changing the portfolio to reflect the reality of which of those are actually delivering numbers, hopefully to catch them as they are growing, and see the stock prices move up according to that.
Right. Nitin, that was the last question. You can give your closing remarks.
So I think there is somebody who has put up something in the chat, Jay.
Yeah, that has been asked.
Oh, okay. So thank you, investors, for being there. I think we are very, very excited by this product. We think this is a product which will help investors who are comfortable investing in known, established uh, large cap companies, or the larger mid cap companies, to be able to identify the best among that lot and actually generate growth. Traditionally speaking, there has been a thought process that if you want large outsized returns, go and invest in mid and small cap and take the concurrent risk associated out there. We've also seen that the experience of investing in mid and small caps without a proper manager or expertise can also create disastrous results, because the ability of many small cap companies to transition into larger caps is not very high in that sense, and that's why the high risk reward ratio prevails. It is our belief that, and hence there is a category of people who say, you know what, we want to be safe, we want those well-known names which make us sleep well in night. Great, but you need to be able to identify those well-known names at the right point of time to see that your portfolio delivers numbers. And in our view, the Tru Blu portfolio addresses that need, because we are identifying well-known blue chip names at an appropriate time to enable returns which are almost on par what we have seen with mid and small cap investing, uh, by virtue of an active management of blue chip names. Again, however, based on a rules-based methodology. So that I think, so we are super excited. I must tell you that when we saw the results of our studies, they were beyond our imagination, and hence we are highly enthused and believe that we can deliver a product which is second to none in the market at the present. Thank you so much.